Welcome to the April 1st, 2019 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman with a fast guided tour of the global financial markets, increasing your education. I'm President, McGowanGroup Asset Management, located at the Crescent in Dallas. Come see us for your own brainstorming session. Start the process today at NetWorthRadio.com. First, headline this week: who is buying all those Treasury bonds? What we've got here is an important graph in financial education. This, your top line graph, is the 10-year Treasury. By the way, that's used to set your mortgage rates. This drop that you see, this historic drop and a surprise according to most forecasts of 2019. It's one of the big stories. We're done with the first quarter, and the first quarter has an inversion. The dreaded Wall Street superstition that an inversion means pandemonium. Why? Because you could go 10 years, and at one point this week, this curve inverted. This is the 90-day Treasury bill yield. Look at this. Above 2.4 on the T-bill at the high this week, and then the 10-year Treasury went below it to 2.356. That's called an inversion. You get more interest for going 90 days than 10 years, but you get duration risk over here. It doesn't make any sense. Pandemonium. And as Alex said on the broadcast, run in circles, scream and shout, because Wall Street thinks it always means a recession. We'll find out, because the numbers, key message for this week, the economic numbers indicate slowing growth, but not a recession. In 2007, before the big recession, we were actually seeing banks fail. We're seeing job losses every month, and the housing market was already hitting the skids. That's not happening at this point, and as a matter of fact, we got 7.6 million jobs available to be filled. That's good news on the current read of the economy, even though growth is slowing. It's slowing in Europe more than it is in the United States, and we're going to get to what that means and why that is part of the reason. This is a lot of money flowing into treasuries, from 3.25%, pushing the yield down to 2.35. That's nearly a 1% drop in yields. What gives? Well, somebody's buying lots of treasuries, and we're about to show you why. The 30-year treasuries first. Look at this. Almost 3.5% at the high point. Peak in rates at the end of October, and boom, 2.8%. Lots of treasury buying. You can see it continuing here, climaxing here at the end of the quarter. What gives? Do you want to go 30 years duration risk for a measly 2.8%? Wow, stuff paying over 5% could be quite valuable now that the Fed has stopped raising the short rates. That was what we saw in the previous graph. This is your price risk. So notice this right here. From this price, this is 126% for the 20-year Treasury. The low was 112. That's about 15% duration risk. If the yields went back to this point, whoop, that's what you'd lose. So that risk says most fixed income portfolios are defective in that they're going to have a hard time doing any better than 2% in a lot of traditional portfolios. High yield portfolios could be the solution. They have more price volatility, but if you're already taking this duration risk for the fixed income allocation, it's time to open the statements and see where your fixed income really is. One market that has emerged in 2019 ahead of the nice cushy 12% or so gain on the major U.S. indexes, 14% for the small stock index here at the close of the first quarter. That's a bounce back from the mini panic of 2018. Some assets have already been through a bear cycle, and that may be where you can get some appreciation. We've covered, this is the Muni bond index right here. No appreciation potential in my opinion. It's at 111% of par. Look at this drop right here. This is the conclusion of our duration risk section. Then we're going to get to energy infrastructure. But look at this, 115 down to about 107. And that big drop of 8%, that's a short-term tax-free Muni bond index. Record inflows. Munis could be overpriced if you're not in the right section of munis, and we found what we believe to be two good places to hang out in the muni market if you want tax-exempt interest. We'll be happy to cover that with you. Go to NetWorthRadio.com, fill out your preliminary client questionnaire for your brainstorming session, and the team that cares will block out time to help you and your family with a real plan. Now we get to the yields on a global basis. Look at this. United States, 2.4% on the 10-year. We just covered that. I can go to Argentina and get 10, no thank you, because they've defaulted twice during my career at least. Mexico, you only get 4%. That's not very much. Canada, 1.6. Germany, negative yield. You pay money to own it. Negative yield for Switzerland. That's no surprise because there's lots of money there. And Japan, negative yields as well. There's about $8 trillion in negative yields in total bond portfolios. That is the answer. Who's buying the treasuries? Well, treasuries pay more. And do I want to go to Germany and have a negative yield, or do I want to take a look at a treasury bond at 2% when the dollar might go up? That's what we believe to be the institutional reason, part of the reason for the drop in interest rates. It's a money flow that doesn't have much to do with us here unless we're speculating in euros or other things. All right, here we go. This is oil, the 5-year chart. There's the low in early 2016 at 26 bucks. There's the high at over $100, $107, currently 60. Well, this pop over 60. You can see some supply in there this week, keeping it below 60. That was probably forward producers hedging. Energy infrastructure and energy assets are actually leading in earnings growth, as we covered in prior episodes. Our favorite is the energy infrastructure, where there are still aggregate yields above 6% available with some appreciation potential, because the price recovery may be just getting started from this bear market cycle that already occurred. I'm Spencer McGowan, President, McGowan Group. Pleasure to be with you. Be sure to subscribe, because when there's fast-breaking financial news and portfolio strategy discussion that we need to get, you're going to get an alert if you're a subscriber. Be sure to share it with your friends. If they ask you for financial advice, this way it gets you off the hook. Just forward them the link. Thank you for joining us right here on YouTube, McGowan Group. My firm, McGowanGroup Asset Management, sponsors NetWorthRadio.com and, of course, our YouTube channel under McGowan Group. Some educational disclosures and discussions that I wanted to add to the broadcast. The first is, I'm very proud of our team, including Stephen Norris, who will be added as soon as we redo the picture. He's our newest team member. Come down, meet the team that cares, get a written plan, because the securities we discuss, the financial news we discuss, that's not a recommendation until you actually come down and get a customized plan at the Crescent. You'll get a tour, and we look forward to seeing you. We're going to cover value at risk of loss in portfolios, and you can see it right here. Learn about our performance, what happened in 2008, how long did it take to recover. All of those items are posted right here at NetWorthRadio.com or the McGowanGroup.com. The other part of the program, when we look at price fluctuations in bear markets and risk control, that's a huge part of NetWorthRadio.com. We look forward to helping you advance your plan and your cash flow. Come down and meet the team that cares.